I'd like to welcome my guest today, Jim Grant of Grant's Interest Rate Observer. We're all interest rate observers these days, Jim, whether it's the ongoing relationship that seems to be changing since the volatility at the end of last year between the intensity of rates and the intensity of stocks. Low inflation, maybe it peaked in the cycle. What do you see, Jim?
What I see, Rick, is a lot of very way out ideas entering the mainstream. I picked up a copy of the Financial Times yesterday and was struck by page one, what they call in the trade a reefer box, meaning, come on and look at this story inside. And it was a reference to a Martin Wolf column, my friend Martin, and the copy read, new tools, new ideas needed to escape low inflation. I thought, escape low inflation?
Why don't you explain to our audience why you think that's so perverse?
Well, I think part of it has to do with the number of birthday candles I've blown out, Rick. I came of age about the time that a Harvard professor named Sumner Schlichter was opining, and Professor Schlichter said we need inflation. We need 2 or 3 or 4% inflation because it lubricates the moving parts of capitalism. It empowers labor unions. It makes us feel better. All right, that was in 1958-60. And wouldn't you know that we got a lot more than Professor Schlichter bargained for. So, Rick, I would say that one of the clear and present risks in today's market is the intellectuals, is the ignorance that knows not.
Jim, let me stop
ignorance.
you right there. Let me stop you right there because you hit on something that we can really enlighten for viewers. If grease in the gears has something to do with high inflation, then what are Mario Draghi and the intellectuals at the ECB thinking with interest rates that are negative as far as the eye can see?
Right. Well, one of the things that Martin Wolf wrote in his column was that he said, perversely, very aggressive central bank intervention has brought us a great deal of debt, which is weighed down on the price level, which paradoxically has induced not the inflation that the central bankers hoped for, but rather a persistent drag that is akin to a kind of a low-level virus. I'm putting that phrase into Martin's mouth. So he says, okay, so we can't do that anymore, but what we must do is spend heavily. We need more deficits, bigger deficits, more spending. And this reminds me, Rick, of something that was hot rather before my birth, which was the phrase secular stagnation. That's coming back into its own, too. This was the formulation of a Harvard professor, of course, Harvard, nice people at Harvard, called Alvin Hansen. And Alvin Hansen said in 1938 that we were in for a long bout of droopiness because immigration was down and the frontier had closed. 1938. Right, so what he didn't see is World War II, the baby boom, and the greatest expansion in economic activity in the annals of America. You know what, Jim, we're going to have
to leave it there. That's a positive note
Rick.
to leave it on. We're going to pick it up with more negative insights next time, Jim.